Hello, everyone. Welcome to our another insightful session of NFO series. I'm Yogita Mongia, investment coach at AssetPlus, and today I have a truly trailblazing guest with me, Mr. Prasanna Pathak, who is Deputy CEO at The Wealth Company. And I'm sure whenever you hear the name of Wealth Company, everybody thinks of Mrs. Madhu Lunawat, and why not? Definitely. So, this is the first Indian women to set up an AMC, and her story is definitely inspiring. She could not be here today, but from tutoring students at 18, at 16 to funding her own education to funding India's first female-led mutual fund house, truly inspiring. And as we all know, the Wealth Company is going to launch multi-asset allocation fund. So we will uncover some important insights about the new launch. And we are definitely delighted to have you, Mr. Prasanna, with us today. Mr. Prasanna comes with more than 25 years of industry experience into analytics, fund management, and definitely a lot more. So, before we dive into this, I would like to hear more from you, Mr. Prasanna. So, why multi-asset, and how did you even think of this new NFO coming by the Wealth Company?
Yeah, sure. Thanks, Yogita. It's always a pleasure to interact with you. So yeah, see, I'll just give you the background as to, why we are thinking about multi-asset and why we have brought the NFO at this point in time. So on the equity fund, so we have launched four NFOs last month, and we have garnered close to around 2,000 crores in these NFOs, and so this is the second round of NFOs that we're starting with, and that's the multi-asset allocation fund that we are looking at. The fund opens on 19th of this month and closes on the 3rd of December. So, regarding this particular fund, I'll just give you a background. I'm a student of cycles. Generally, I understand cycles to some extent, and understanding cycles, especially in the current context, is very important, right? Cycles is a basically law of nature, right? Everything that you can think of is ultimately cyclical, and that also applies to various asset classes, including equity, gold, debt, and so on and so forth. Within equity, also we see cycles within large cap, mid cap, small caps. Even stocks do tend to have cycles, right? But the good thing about cycles is cycles can be different for different asset classes, right? Especially if those asset classes are uncorrelated. And I'm underlining the word uncorrelated, yeah, because if you are looking at gold and silver, for example, right, they are correlated assets and the cycles may be similar, right? If you are looking at equity and something linked to equity, the cycles may be similar, right? But if you have in your basket or in your portfolio or in your fund three asset classes which are totally uncorrelated, I think that really adds to the chemistry, and that can significantly reduce your volatility, right? Because the moves are very different during various time frames, right? So, generally, now coming to the current context, right? My view is, when I study cycles, earlier the cycles used to be like an 8 year kind of a cycle. I mean, you look at 1992, you look at 2000, 2008, 2017, and 2024, right? Those cycles tends to be a 8 year kind of a cycle. But what we are experiencing now is the cycles are reducing. So when I'm saying cycles are reducing, I'm conversely also saying that volatility is increasing, right? And we expect the volatility to be on the higher side, especially for the next 8 to 10 years. And so this is what our cycle study is saying. But if you just turn on the papers of newspapers, right? We can also see what is actually happening globally, right? So there is a tectonic shift in the power equation which is happening globally, right? So there is a country which has led the world for the last century, right, for 100 year plus, and now we are seeing those power shift taking shape. So generally, such power shift are not very short term, right? I mean, it takes a long while when this power shift and the balance gets established. So again, so that also corroborates with this thought that, I mean, we are looking at a 8 to 10 year volatile period, and obviously the uncertainty and whatever geopolitical situation that we are witnessing also points to that stuff, right? So during this volatile time period, I think investors should have a fund wherein, because of this uncorrelation of or lower correlation of assets in three different types of assets, they can in principle reduce significant volatility, and they can tide over this volatility in a much smoother ride. And that was the entire pretext, and that was the entire reason for having this multi-asset allocation fund.
You for your insights on macro environment and how does a multi-asset actually fit in this environment. So, with mutual fund industry more than 75 lakh crores plus, penetration still low, and we are aiming at a higher number in further years. So, definitely mutual funds. If we talk about in mutual multi-asset, definitely makes more sense. So, my another question would be, which asset classes are you planning to be underweight, overweight, going forward?
Yeah, there's a dynamic framework that we have established wherein, I mean, we will be dynamically moving across these asset classes, and I'll also run you through that framework. But before that, I just wanted to show you a few data points which we had collected, and I've been in the market for the last 25-year plus, right? And even I was kind of really taken aback. I mean, it's very counterintuitive that this data is there. So I'm just sharing a presentation. I'll just highlight a few slides which basically makes those points, right? So to begin with, I mean, this quote is very important, and this is something that I genuinely believe in, and that is where, I mean, we can see that the multi-asset allocation fund is very important during these times. So, coming to the multi-asset allocation fund, I mean, these are the 4 or 5 main reasons why investors should look at a multi-asset allocation fund, because no single asset class outperforms consistently, and leadership keeps changing. The negatively or uncorrelated assets, like I was saying, can significantly reduce volatility. What I mean, we are also pointing out to the fact that gold actually, because otherwise for equity and debt, we also have balance advantage funds and hybrid funds, etc. Right? But the point over here is gold actually being not correlated to either equity or debt. So that actually adds to the zing, and some data points that we have found about gold is actually very interesting, which I'll show. Obviously, the fourth is it helps to achieve a better risk-adjusted return, or better Sharpe ratio. I mean, it can result in better Sharpe ratio. And on the tax front, I mean, if you have a equity-oriented multi-asset fund, I mean, the taxation is similar to say an equity taxation. But even for a hybrid multi-asset allocation fund, after 2 years, I mean, the taxation is obviously an equity taxation, and any investor who is looking at investing in any fund of a mutual fund should minimum have a 2 year horizon. So for him, for a slightly medium term investor, the taxation doesn't should not matter at all, right? And it is the tax efficient fund to begin with. So, I mean, we are just talking about, I mean, how asset classes change leadership, right? So this data basically shows that in the last 15 years, out of the last 15 years, gold was actually the best asset class for that particular year. And this is counterintuitive because, I mean, someone who is very closely following equity would have thought that equity is the one who actually outperforms most of the times, right? But that is not the case. I think gold silently has been doing its work. I mean, it has been in the limelight for the last 1.5 years because of the run up that it has seen. But otherwise, also, in a volatile or in an uncertain environment, whenever equity returns are minimal, I think gold tends to outperform, and which is what the data is also showing, right? So that's the first point. The second very important thing is various asset classes can go through longer period, prolonged period of consolidation, right? So we have had a longer period where between 17 and 20, where equity returns were zero, right? So similar is the case with gold, and similar is the case with debt. I mean, there can be longer period when it can give lower returns, and therefore, I mean, instead of having a single asset, if you have a mix of say 3 to 4 assets which are totally uncorrelated, that saves the day for you, that reduces volatility, and you will get certain level of returns even in a volatile environment, right? And that is the entire point that we just wanted to highlight. The third is the correlation that we are trying to show, wherein we are saying that gold is totally unrelated to both equity and debt, and it is an asset class on its own. I mean, so it has nothing to do with equity and debt, and it can give good returns even when equity or debt is not performing as well. Yeah, so that is a very important point. The other starting data, or a very important data, is what we have seen in the last 30 years CAGR. Actually, gold has outperformed equities, right? So that is what, though not by a larger margin, but the kind of volatility that gold offers versus equity is significantly lower, right? Even if you remove the last 1 year run up which gold has seen, I think the returns are similar, though it has underperformed equity, but the returns not by a larger margin. And if you adjust for the volatility, I think gold definitely offers a good case for basically having an asset in your portfolio apart from equity and debt as well, right? Now, coming to the most important thing is, I mean, why? I mean, how are the multi-asset? So there are 38 multi-asset funds in the industry. What is the difference between various multi-asset allocation funds, and what is the fund that we are bringing? I mean, in which category are we bringing in the multi-asset allocation fund, right? So most of the multi-asset allocation funds which are there are equity-oriented fund, right? So when I am saying that equity-oriented fund, there will be minimum 65% invested in equity and arbitrage put together at all points in time, right? And they also need to invest in debt minimum 10%, right? So a fund manager who is managing this portfolio, I mean, he won't stick at 65, right? He will have at least a buffer of 2 to 3 percentages. So he'll go to around 68, 69% for equity and around 13, 14% for debt. So which leaves the window for gold, which is like a minimal window, right? So the minimum which is required as per the multi-asset allocation is a 10% gold. So when he is bearish, he'll have a 10% allocation to gold, and when he is bullish, maybe he'll have around 16 to 17% allocation to gold, and that is the only window which is available. So since we genuinely believe in the kind of data, especially that gold has to offer, we believe for these asset classes to work together, right, as a chemistry between themselves, a minimum allocation of 20 to 25% is something, because we don't know which asset is going to perform at what time period, right? So minimum allocation of 20-25% is warranted to have from a long term point of view, and therefore we have launched this fund where the windows available for all these asset classes uh, are much wider. For example, for equity, it is 10 to 80%, for debt, it is 10 to 80%, and for gold, it is 10 to 50%. And that we believe is something which is different from most of the multi-asset allocation funds. The other difference is the point that you are asking is, I mean, how the allocation is going to be across this three asset classes. So, like I was just saying, for the chemistry to work, at least 20-25% in each asset has to be there. And because of the dynamic framework that we have established, we believe that we can move it from 25 to 40 depending on various parameters. We also have the dynamic framework which we can discuss, but yeah, I mean, so that is more about it. I mean, it is the framework, dynamic asset allocation framework, which allows us to move the allocations across these asset classes. Yeah.
Thank you for that valuable insights on correlation between the different asset classes and how you're going to put forward when it comes to the wealth company multi-asset allocation fund. Also, it'll be great if you can, walk us through how you plan to rebalance and what generally triggers a tactical shift.
Right. So, this is the framework that I was talking about, which is the dynamic asset allocation framework. So, so our starting point is going to be the commodity or gold per se, right? So here, for any commodity, demand and supply is the main driver, right, which determines the pricing of a commodity and how the movement of a commodity. So that we have used as the basic crux wherein we determine as to what allocation should go into gold. The second very important thing is the market cycle study, right? So cycle study, which I have already talked about. So we are using that also as a second level of parameter for changing the allocation. But we are not stopped here. We are also using various momentum and technical parameters as well, because we might go wrong in our demand and supply as well as the market cycle. So the technical and the momentum parameters will prevent us from getting into any mistake because of wrong identification of the demand and supply or the cycle as well. So that's the third level of guardrail that we have. The other things that we have inputted in our asset allocation framework is the US fiscal uncertainty index, right? So there's a index available on the US fiscal uncertainty, and as we know that gold is very has a very strong correlation with what the US fiscal condition is, and so on and so forth. Because it is very closely related to dollar, and dollar is closely related to what is the US fiscal situation. So that is the third or fourth level of guardrail that we have used. There's this global geopolitical uncertainty index as well, because as and when during uncertain times, people generally tends towards gold, right? So as and when the uncertainty increases, so this index also has very strongly correlated to the movement of gold, and that is the fourth level of input that we have used. And the last is, we have also used ratios such as gold to S&P 500 index ratios, gold to silver ratio, etc., and obviously dollar index, because again gold is very strongly correlated to dollar. So these are the 4 or 5 parameters that we are using to determine what allocation are we going to have on gold. And like I was saying, typically we would be tending to have close to around 20% at all times, and moving it to say 30-35% as and when we are very bullish, and the scenario changes and so on and so forth, right? For equity, again, there are various parameters that we'll be using, like price to earnings, earnings yield, and PEG ratio, and growth, and so on and so forth. So there's a separate parameters and framework that we are using for equity, and that would be the balancing portion.
Great, good to know that. And I think our partners are also delighted to have this information. So, one last question for the better understanding of everyone. Um, what benchmarks or peer group do you compare the fund against, like in total, when we have all the asset classes combined in this multi-asset allocation fund?
So multi-asset allocation fund itself is like a category, right? And like I was saying, there are two types of multi-asset allocation funds. One is the equity-oriented fund, and one is the hybrid fund. So our fund comes under the hybrid category per se. So it is actually comparable to the hybrid multi-asset allocation fund category. And when you compare your returns, obviously investors tend to compare it. Any fund, they generally tend to compare with equity per se. But what I would like to highlight is one is that you should also consider the volatility of any fund when you are comparing the return. So historically, what we have seen, the multi-asset categories have delivered returns closer to the equity returns, 1 or 2% here and there, depending on the market conditions. I mean, in a very bullish kind of an equity scenario, obviously they lag, but the longer term returns tend to be merging closer to the equity returns, right? I mean, if you go beyond 10-year, 15-year, 20-year, 25-year, the returns tend to merge towards the CAGR of equity, maybe 1% or 2 here and there, but it comes with a much lower volatility, right? So that is more important.
Thank you for answering all the questions so patiently and definitely at length. And since it is going to launch tomorrow, wishing you all the very best. And thank you so much, Mr. Prasanna, for being here and giving your valuable insights. Thank you so much.
Thank you, Yogita. Thanks a lot. Yeah.
Yeah.